You're listening to certified financial planner Doug Goldstein, host of the Goldstein on Gelt Show, www.goldsteinongelt.com.
Okay, I'm very excited to have on the Goldstein on Gelt Show Grant Williams, who has spent 30 years in the world of finance. He's been with UBS, Credit Suisse. He's been from London to Tokyo, New York to Singapore. He's got a very interesting newsletter called Things That Make You Go, I'm not sure if the newsletter is as interesting as the title, but no, I'm kidding. I know it is. And he's also involved in Real Vision Television. Grant, you've been around the block and you've seen so many ups and downs in the market. And, these days there seems to be a lot of chatter and fear among people on the one hand, and other people are very optimistic. How do you get through the chatter to really try and understand what direction the world is going financially?
Hey, Doug. First of all, thanks for having me on. It's a great pleasure to be here. It's a great question to kick off with. It's funny, bubbles generally only ever are evident in hindsight, certainly to the masses. And in the middle of every bubble, there have been plenty of people talking about the sky falling in. And the trouble is the sky always does fall in at some point. So everyone that says the sky's going to fall in is always right. It's just a question of timing. And that's kind of where we are now. There are a ton of metrics.
Wait, hold on. Sorry. I don't want to get too specific. You're saying that's where we are now, but that's where we always are. So if I'd asked you the same question 5 years ago or 10 years ago, or if I ask it to you again in 5 years, is your answer going to be the same?
Well, it's a question of degree. If you look at what's happened since '08, we've had this massive rebound, and the people who fear the worst will point to the reason that rebound has occurred, and the people that don't fear the worst don't really care. They're just riding the trend. Mm-hmm. And they're both perfectly acceptable ways to play this. The problem comes when you get to extreme valuations, as we are at now. If you look at, there are plenty of metrics in the stock market which will tell you that they're all-time highs, whether it's sales.
Before we get into the metrics, because I speak to a lot of people on the show, and some of them are more optimistic and some of them are more pessimistic. And it feels like, and I didn't mean to cut you off because I know you have metrics and numbers, but it often feels like there's so many different metrics that people use to look at the market that depending if you're talking to whether it's a guy, a Republican or a Democrat, or an optimist or a pessimist, or someone who's just doesn't know or knows too much, you're always going to get a different view on it. At the end of the day, how can a normal person begin to really dig through this?
Look, I guess if you want to boil it down, it's about risk. And every person has their own bugbears, their own risks that will hurt them more than other risks. So you have to take a pragmatic approach. And instead of being an optimist and a pessimist, just be a realist. And if you find yourself invested in a way that could hurt you if there is a bad outcome, if there's a recession or a stock market fall, let's not say crash, you have to understand how best to mitigate the risk. If you think it's a risk worth taking, then fine. But as expansions continue for longer, the risks of a recession, for example, increase. And there comes a point in time where you have to think to yourself, okay, the chance of a recession and a correction in these markets is now sufficiently high that I need to take action. And whether that's to raise cash or switch from equities to bonds, it's up to every single individual person. And I think people get caught up in listening to so-called market experts. And instead of sitting down themselves and taking a realistic approach, if something bad happens, what does that mean to me? That's the most important question everybody has to answer.
Yeah, that is a great point. I think that the idea that people have to realize that they themselves are different from their neighbors and they're going to all have a different tolerance for risk. What about the model of investing, which I hear a lot? My day job is I am a financial advisor. So I get to speak to people really nuts and bolts about what they hope to do in the future and what their dreams are and their goals. And we try to develop, we have to convert that into what are we going to do today? And a lot of times, and I feel the same way too, I'm kind of optimistic. I say, look how cool the technology is and look how much better medicine is and life expectancy and the trajectory is so good. Do you think that's enough for someone to say, I'm just not going to worry about it. Let me just put my money in the market, money I don't need in the short term, and I can handle the volatility and just let the wonders of the world carry me to wealth over the years. Is that a model or is that just naivete?
No, I think it's a model, but I think it depends wholly on your age. If you're a millennial right now and you're in your 20s and you want to invest in markets and you have money you can put in there gently each month and you're not going to touch it till you're 60, that's great. You're right. Put the money in the markets and don't worry about it. If you're a boomer, and we've got the largest generation in history to ever retire, are starting to retire now, and unfortunately they have the highest allocation they've ever had to equities, which is around 70%, then a correction in the stock market is a meaningful problem that you have to kind of try and mitigate. So yes, over time, I think markets generally tend to go up. We are evolutionary creatures, and markets have an inflationary aspect built into them, so go up over time. But it really comes down to that time frame. Anyone nearing retirement needs to think very, very carefully about the next 5 years rather than the 20 years ahead of them, which a millennial can.
We're speaking with Grant Williams from the newsletter Things That Make You Go, I love the title. I just like saying that. And one of the founders of Real Vision Television. He's been talking to us about the idea that it doesn't matter when you invest whether you are an optimist or a pessimist. Be a realist. Look what's going on. And most importantly is invest for who you are and what you need. For example, if you are young and have a long-term outlook, then it's okay to be in the market, even if it does have crashes, which surely it will over your lifetime. But then, Grant, you spoke about the baby boomers, and many of them certainly have a lot of money in the stock market, and now they're beginning to think, A, about protecting their portfolio, but B, about the fact that they might live 10, 20, 30, 40 years or more, and they realize they need to have some growth in their portfolio just to stay in front of inflation. So how can someone in that situation begin to think about protecting his portfolio?
Well, look, I think that's exactly it. It's about protection. It's about understanding the risks, as we spoke about earlier on. And right now, we have the third longest expansion in history going on in the United States. And as the United States markets move, so go the rest of the world in general terms. And if you look at every recession in the US since 1980, the average drawdown in the stock market has been 37%. So that's a set of parameters, a set of problems that you have to think about. If you're about to retire, you have 70% of your money in equities, and there is an above average risk of a 40-odd% drawdown, that's something you have to take very, very seriously. And ordinarily, you would be switching your equities into bonds, so you'd have some income for your retirement. But obviously, bond yields are at all-time lows, or there or thereabouts, so that's a problem. And cash, you're getting no return on cash. So to me, having cash now gives you an option on essentially every asset on the planet at an indeterminate strike price. If you have cash in the bank, yes, you're going to lose money over the next year in real terms, potentially 0.5%, 1%. But if you think the possibility of losing 10 or 15% in the equity markets is high enough, then paying 1% premium to own that option to buy things 10, 15% cheaper makes a lot of sense to me, particularly if you are coming up to retirement.
Yeah, I'll tell you, Grant, I really like that strategy, different from the much more complex strategies that a lot of times people try to sell, things like options strategies. They say, well, you could buy puts on the market, or you could hedge, or you can buy this alternative investment. And so often these are illiquid, complex, expensive investments, but people are desperate for yield. They're desperate for a solution, especially as they're entering their retirement, that they fall victim to a lot of these. I don't want to call them scams, because they may not be scams. They just may be inappropriate investments for someone, let's say, who's in retirement year. But you're saying that using cash is, the expression on Wall Street often is cash is king. And the cost of liquidity, because everything has a cost, if you want to be liquid so you're nimble and able to invest when things look better, okay, so you're going to pay the cost of having the cash sitting there doing nothing, but at least it's available to you and not losing, at least in nominal terms. That's a model that really seems to work. You think that's reasonable for most people, or that just makes them market timers, and market timers tend to be people who often lose?
Well, I think as markets increase, if you can raise cash on the way up, and once you get to a level where you start to feel a little nervous, just gently raise cash as things go a little higher. Just sell a little bit of your positions off and take the cash. If you've invested money in the US stock market in 1982, when nobody wanted to own stocks, they were trading at a 6% dividend yield and only 6 times earnings. When you bought those stocks, you knew that buying them at that price, you could just forget them. And you've been able to do that. You've been able to just sit with those stocks for the last 30 years, and they're going up and you're in great shape. Whereas if you buy stocks now, that's not a comfortable position to be long. You certainly can't take your eye off the ball and leave them for 20 years like you could back in the 80s. So it's really about buying at the right price rather than selling at the right price. If you buy things at the correct price, it takes care of a whole lot of problems for you.
Yeah, I think that's also important, you sound just like Warren Buffett, who said, you got to look at what something is really valued at. Are you also a multi-billionaire? We'll say that for next time.
I'm between midnight and 3 in the morning when I'm asleep.
But the advice is very good. Listen, Grant, we are just about out of time, but I know you share a lot of your ideas and advice elsewhere. Tell us in the last few seconds, how can people follow you and follow your work?
A couple of places. I write my letter, Things That Make You Go, which is, the website is ttmygh.com. I'm on Twitter at TTMYGH, and then Real Vision Television, which is another project that I'm involved in and very proud of, realvision.com, where we interview, like you do, some of the smartest investment minds in the world.
Wow. And you are one of them. All right. Grant, I really appreciate you coming on to the Goldstein on Gelt show. We will put links to all of that at today's show notes at goldsteinongelt.com. Grant Williams, thanks again.
Thank you, Doug. I appreciate it.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.